There is a silent, invisible war being waged across the sprawling arteries of global trade, and if you are only looking at traditional earnings reports, balance sheets, and standard Wall Street consensus metrics, you are entirely missing the battleground. With Security Matters plc, Nasdaq, SMX trading around the $16 mark against a microcap valuation of roughly $17.5 million, the mainstream financial media writes it off as just another volatile, low-float ticker subject to retail chatroom chatter and algorithmic whipsaws. But beneath the headline price noise and the punishing multi-year downtrend lies a profound structural reality that global supply chains, luxury conglomerates, and environmental regulators are desperately scrambling to solve: the total absence of physical to digital material accountability. For decades, modern capitalism has operated on a colossal blind spot. We trap data packets with absolute cryptographic precision across fiber optic lines, but the actual physical atoms, the raw polymers, the critical minerals, the recycled plastics, and the high-value commodities moving through cargo ships rely on paper certificates, easily forged barcodes, and superficial packaging labels that can be swapped out, diluted, or counterfeited with impunity. Retail investors scrolling through Robinhood or discussing momentum setups on X see a chaotic microcap chart. Institutional algorithmic desks see high volatility and low liquidity. Yet the physical bottleneck of our global economy isn't about how fast we move data, it's about how untrustworthy our physical inventory remains. SMX operates right at this fault line, fusing chemistry, physics, and distributed ledger tech to give inert materials an immutable memory. When you look past the retail confusion and examine the core physics of submolecular tracking, you realize that SMX is attempting to solve a multi-trillion-dollar transparency crisis that traditional supply chain software cannot touch. Dive into the daily order books of SMX and you will witness a textbook masterclass in microcap market dynamics. With a remarkably restricted public float and a market capitalization hovering near $17.5 million, daily trading volumes can fluctuate wildly, reacting intensely to macro jitters, sector-wide liquidity squeezes, and algorithmic momentum triggers. Institutional heavyweights rarely accumulate microcaps like SMX through massive daylight block orders. Instead, they utilize quiet consolidation phases, low-volume drift, and localized liquidity voids to build positions, while retail investors, weary of historical drawdowns and structural reverse splits, get systematically shaken out in frustration. This is the classic psychological trap of the microcap arena. Retail traders look at a steep, multi-year chart decline and scream value trap or dead money, completely blind to the asymmetric volume spikes that occur the moment structural institutional demand steps in. When regulatory compliance deadlines or unexpected commercial validation announcements hit the wire, a microcap with a low float doesn't merely tick upward, it violently reprices. Think about how modern retail trading behaves. It demands instant gratification, immediate momentum breakouts, and viral social media catalysts. When a stock undergoes severe corporate restructuring or complex capital adjustments, retail capital flees in panic, leaving the order book hollowed out. But savvy market participants understand that liquidity vacuums cut both ways. Drop even a modest wave of institutional buying or strategic partnership news into a thin order book, and the resulting supply squeeze can trigger exponential percentage surges before traditional market makers can adjust their spreads. Before we unpack the proprietary chemical tagging mechanisms driving this technology, let's pause for a moment. Are you currently tracking low-float microcaps as asymmetric alpha plays in your portfolio? Or are you sitting on the sidelines waiting for definitive confirmation of a macro trend reversal? To truly understand why SMX commands attention away from standard tech plays, you have to discard outdated historical framing. Traditional supply chain tracking has long been categorized as boring legacy software, enterprise resource planning systems, basic RFID tags, QR codes, and serial numbers printed on cardboard boxes. These legacy tools suffer from a fatal flaw. They track the container, never the content. If a malicious actor intercepts a shipment of certified recycled plastic, luxury gold, or critical industrial polymers, they can strip the barcode, swap the contents with virgin or illicit materials, and the digital paper trail remains entirely unbroken and blissfully unaware of the fraud. SMX shatters this archaic paradigm by shifting the locus of security from the packaging to the molecular structure itself. The company's proprietary technology utilizes invisible, permanent, or removable submolecular markers, mixtures of chemical or physical signatures that can be embedded directly into solid, liquid, or gaseous materials during the manufacturing process. Think of it as introducing synthetic DNA into industrial supply chains. These markers do not alter the physical or chemical performance of the host material, whether it is a high-grade polymer, a precious metal, or a chemical compound. Yet when scanned using specialized optical readers and verified via proprietary algorithms linked to a secure digital platform, the material reveals its exact pedigree, origin, composition, and life cycle history. This creates an unbreakable digital twin of the physical asset, bridging the physical and digital worlds in a way that traditional software integration has never been able to achieve. Looking toward the multi-year horizon, the growth catalysts for SMX are increasingly being forced by regulatory mandates rather than optional corporate virtue signaling. Across the European Union and expanding corridors of the United States, sweeping legislative frameworks such as stringent anti-greenwashing rules, mandatory digital product passports, and aggressive bans on unverified industrial waste and non-compliant plastic recycling are transforming transparency from a nice-to-have feature into a strict legal prerequisite to do business. As state and federal recycling mandates tighten, companies can no longer rely on self-certified supplier affidavits. They need objective, forensic, scientific proof of origin. As a technological gatekeeper in submolecular authentication, SMX positions itself right at the center of this compliance storm. However, investors must remain clear-eyed about the execution risks. Commercializing deep tech chemistry requires long enterprise sales cycles, capital-intensive validation phases, and continuous balance sheet management to fund global expansion. Macroeconomic headwinds and capital expenditure shifts among mega-cap tech and industrial spenders can occasionally delay pilot programs from transitioning into full-scale deployment. Yet looking past short-term price noise and microcap volatility is essential for anyone analyzing this space. When the structural demands of global regulation collide with the physical realities of supply chain fraud, the companies holding the foundational patents for material authentication will not be judged by daily chart fluctuations, but by their indispensable utility to the architecture of global commerce.